Carl and Sarah. Welcome to the Halftime Report. I am Frank Holland in for Scott Wapner. Front and center at this hour, the big comeback. The Nasdaq just on the brink of going green following some steep losses at the opening. All the major averages, they're well off their lows as oil pulls back from a near 4-year high. Our investment committee standing by here to break down this entire turnaround and much more. Joining me for this hour, we have Joe Terranova, Steve Weiss, and Jim Lebenthal. But first, quick check on the markets right now. You can see we are in the red across the board, but as we mentioned, the Nasdaq just fractionally away from being flat. The Dow down just about 430 points. The S&P pulling back about 0.5%. You can see oil up over 5.5%, but well below $100 a barrel. Right now trading at just about $96 a barrel. And I think that's where we have to start, Joe. The impact that the rise of oil prices have had on the broader economy. I have to include in there also diesel prices here in the U.S. We're going to talk more about that. Really the fuel for transportation here in the U.S., raising the cost of shipping. But in general, consumer confidence falling on these rising oil and gas prices. What do you do today on this Monday with so many questions about Iran and the path forward?
That's a great question. Look, I think markets have a rhythm for their movement, and I think 2026 you could define the rhythm of the market as a roller coaster. It feels as though each day it's exactly that. You get on the roller coaster and you basically get off in the same spot. The operator of the roller coaster right now appears to be the price of crude oil, and wherever the crude oil market is going to go takes where the overall market is. There's resiliency in the market for sure. I continue to say if you have a hyper volatile environment where it is resembling a roller coaster, just this ride basically back to where you began, in that scenario, what do you want to do when everything looks really, really good? You probably take the other side of that. When everything looks really bad, you take the other side of that as well. But as it relates to crude oil, at the end of February, the average volume for spot crude oil was 300 contracts per day. We're now running close to 1 million contracts per day being traded in spot crude oil. So, look, that tells me I understand the fundamental concerns that speculators might have, but that's beginning to feel a little bit like silver 1 month ago, where we're beginning to see some of the excessive speculation take hold within the marketplace. Take comfort in two things. Last point. Number one, we are seeing that the Mag 7, in particular, the NVIDIA, the Alphabet, the Apple, they're doing what they're supposed to do. They're being perceived as quality, a port in the storm. And then I think you have to look at the fixed income market and see the incredibly calm environment. So far, year to date for a 10-year Treasury, you're talking about only 38 basis points with a range. Fixed income trading really well. You know, you mentioned the word resilient, or resilience, I should say. Some people are also saying complacency. I'm looking at the S&P about 4% away from its all-time high. The NASDAQ 100 about, 6% away from its all-time high. Steve Weiss. Are investors, and Joe just mentioned the bond market, are they complacent or are they resilient in this situation? The fact that we might even see the NASDAQ turn green during this show?
Well, it's an interesting question. By the way, I think I'm tired of the word resilience. Everybody uses it for everything. Investors resilient, retail's resilient.
What's a better word?
Resilient. There is no word for it because it really doesn't come into play. Markets go up 90% of the time. Anytime you sold during geopolitical risk, or anytime you sold, period, right, over the last few years and stayed out, the market's higher. So in terms of complacency, that makes you're essentially making the judgment that there are real issues there that the investor is ignoring. And the truth of the matter is we don't know. So if you go back to how everybody was looking at this year, not just me, but you and everybody, volatility, right? Now, nobody expected this kind of volatility. This is volatility on steroids. And you can look at volatility, you look at it one of three ways. Okay, retail investors tend to look at it as risk, right? Others, I think, hedge fund managers, professional managers look at it as opportunity, right? Displacement, either to get out of shares. Volatility cuts both ways. It goes up, right? There's volatility higher, volatility lower. And then you can look at it as a nuisance. I think in this market, it's a nuisance for now. However, if you ask me what I'm concerned about, and I mentioned this on Friday, I am concerned about stagflation. We're seeing jobs growth negative. We're seeing inflation hold before this higher than what the Fed was looking at. So when you have inflation moving higher and the economy moving lower, right? That's stagflation. Now, the question is, how long will that last, and are we actually in it? We don't know. Everything at this point depends on the duration of the war. Trump could come out any day, any moment, and say, hey, victory, right? And we'd all go home, market would go up. And you still won't see the impact of the problems until later on. So the point of all this, my conclusion is that you hold where you are now. Anytime, as I mentioned again last week, you tried to catch a falling knife, you know, you made a mistake. You got cut hands instead of buying values. So I think you can wait, right, to put money to work. Having said that, depending upon your time frame, depending upon what you're buying, right, you can hold it, except for things that I still think were very overvalued going into this. They're still overvalued.
Are you lumping software in that group? Are you
software?
lumping
I bought Microsoft.
Discount retailers in that group? Because a lot of things are falling that I don't think people thought were overvalued until this happened. The rise of oil prices changes the math.
That's not true in software. That's not true in software.
No, I'm asking, are you counting software? But discount retailers, I didn't hear anybody.
But not because of
nobody said those were overvalued until this happened, and now all of a sudden we're seeing calls for those to sell low.
That's not true. Plenty of people said software's overvalued.
No, I said discount retailers. I'm saying there's different parts of the market. Yeah.
Discount retailers, you just don't know. You don't know how this is going to perform.
Okay.
Look, most of the, two-thirds of the country lives paycheck to paycheck. So now with fuel prices going up, how they've gone, I mean, saving grace, we've got warm weather across the country, right? So less heating costs for this time of year. But now they've got to put gas in their tank. They've got to put energy into their home. Right. So discount retailers, they're going to have a tough time.
All right. You don't like resilient. What about constructive? Jim, I'm going to come over to you. Mike Wilson from Morgan Stanley out with a note saying in part, I'm just kind of summarizing part of it, we think we're closer to the end of this rolling correction than the beginning, talking about the falling knife that Weiss was just mentioning. And Morgan Stanley remains constructive over the next 6 to 12 months, speaking of a time frame. Agree or disagree with that take?
I can't agree or disagree on it because it requires some prediction of when the war is going to end, and that's not knowable. That's not something that, you can do a degree of analysis and come up with when the Straits of Hormuz are going to open to tanker traffic again. However, that is the key point. That is the pivot point upon which the markets hang right now. When you start to see tankers other than Iranian flagged or Iranian associated tankers transiting the Straits of Hormuz, that's when you'll see oil come down and you'll see the markets rally with it. The weakness in the market, and as much as I'm happy to see that there's been an intraday rally, I'm not sure I trust it because the markets just don't know how long this oil spike is going to last, and it will do damage. The good news here, Frank, is before it does damage, there are cushions both in the economy and the financial markets, whether it's growth in GDP, whether it's the fact that inflation had been coming down, profit growth, stimulus from the budget bill, a number of cushions, but we see those cushions being eaten into, for instance, with Friday's labor reports. The point of this being is that the longer this goes on, the more damage will be done, and frankly, there isn't that much time left until we get the Straits of Hormuz opened if we want to avoid damage. The president says this is a 3 to 4 week operation. Okay, if that's the case, maybe we'll skate through without lasting damage, but frankly, I think the markets want to see tankers transiting the Straits of Hormuz this week. I'm going to keep my disciplined, diversified portfolio. I'm not panic selling here at all, but I am keenly awaiting news of tankers transiting the Straits.
But it's not just when the Straits open. It's if there's more damage done to the oil production facilities in Saudi Arabia, throughout the Middle East. That's part of the issue.
I want to refer to something our Brian Sullivan has said because he's coming up in just a second. He said it's not just about getting the oil out. It's if other ships feel safe enough to go back in and just keep the supply chain going. So speaking of Brian, for much more on the turnaround in oil, I want to bring in our Brian Sullivan. Brian, we're looking at oil move lower. We're also looking at the NASDAQ right now, Brian, very close to at least flat, possibly turning green, looking at oil WTI at least, trading about 96.60 a barrel. What's the very latest?
Well, we got some breaking news on CNBC.com, which I think goes exactly to your conversation about the Strait of Hormuz. And if I'm right, this could bring oil down even more. I'd love to get the former oil trader Joe Terranova's view on this. But the Iranian Foreign Ministry is saying, and I'm not sure where they're saying this, it's up on CNBC.com right now, that any tanker transiting the Strait of Hormuz, quote, must be very careful. Now, interesting language, because if you read into that, and again, love Joe, the former trader's take on this, if you read that, must be very careful is not we're going to blow you out of the water. It's you cannot pass the Strait of Hormuz. It is not we're going to send missiles your way. must be very careful. To me, and I'd love to hear everybody's view, to me, that feels like, that sounds like a slight de-escalation. You can see the live map there, Strait of Hormuz right at the top of your screen. A lot of ships at anchor on the right, kind of waiting to get in. A lot of ships at anchor on the left, waiting to get out. Nobody's kind of in the middle. But we'll see if those words, must be very careful, make it a little more amenable for some ships. Now, guys, we have had, I want to be clear, this whole, the Strait of Hormuz is closed. I don't like that word. Great job, guys. It's not, nothing's closed. There's no gate on this. You can make it risky. Plenty of Iranian and Chinese flagged or cargoed vessels are getting through because they're not going to blow up basically their own ships or their own oil. But I do wonder, and let's see what happens with the price of oil. And then the point I was going to make, guys, is this. And if you look out, we always show the front month contract, the April contract. That's the one that's up on the screen. But if you look out, there's other contracts, May, June, July. Look at that. I say it, and it happens. And you could see the price. And if you're on the radio, 96.47 for the front month for April. And you got 92.5, 86, and then basically just under 82. That's indicating, A, the market expects, it may be wrong, but it expects things to calm down. But also, I think it goes, Joe, to the extreme options positioning that we had in the market. You'd mentioned at the top of the show how, it's 3 million or whatever contracts. A lot of those were net short, which means when we got the escalation last night, everybody had to cover. They got their faces ripped off. And that's why we saw the price of oil have the biggest intraday spike percentage-wise in the history of oil, 35% gain. And it's also why oil's come down, because you've got those people they've covered. And now the market, I think, the positioning is going back to normal. But I'm watching these headlines coming straight off the Iranian Foreign Ministry. Feels like a de-escalation.
All right, our Brian Sullivan at CNBC headquarters. To your point, Brian, we're looking at those forward contracts. Certainly, it seems like the market is pricing a de-escalation. We'll have to wait and see. Brian Sullivan, thank you again. Joe, he called the shot. Former oil trader, you and I were talking about this before the show, the fact that you made, your bones in the oil market. What is your view of some of the things that Brian's talking about, the short covering, and just also this sense that the market seems to see some type of de-escalation coming up?
Well, I guess I didn't make enough bones because I'm sitting here with all of you, but I tried my best to do it. And understanding the market, when you look out on the curve, what you see right now is significant backwardation. And this morning I was looking at the curve and observing where we are in terms of the price gains months to date. So spot, you're up about 50%. You move out into the June and July contracts, you're up about 30 to 35%. Where I think the expectation that ultimately this conflict resolves itself is when you move into the fall. Those contracts month to date, they're only up mid-teens at best. So it looks like the market is expecting that you could have simmering tensions even as we move through the summer. They tend to alleviate those tensions as you move into the fall. To Brian's opening remarks surrounding the comments from Iran, look, protecting oil assets, I believe, is in everyone's best interest, including Iran. It would be sabotage for them to do something where the response would be to destroy or to impair their oil infrastructure. That's their economic lifeline. So whether it's the U.S., whether it's China, whether it's India, whether it's assets in the Middle East and the interest of everyone, I think the expectation is that you're going to protect these oil assets. And I do think right now, as I said at the top of the show, I do think you have to build in some excessive speculation into the market right now as far as what's unfolding. Again, it has that feel to me as precious metals did 1 month ago.
The only one that wants a straight close is Russia. Let's be clear about that, right? Because they want Russian oil to go out more in the market. China, obviously, I would say obviously, I don't know this for sure, but China has to be in Iran's ear. They've been a big benefactor of Iran, and they're not getting their oil, and that's where they get most of it from. So they want to flow through the strait. So they say be careful. I think it's a real leap of faith to try and parse what the Iranians mean by what they say or take it on face value. That's a big mistake, as we've seen
in a developing
history.
situation, especially.
Right, in a developing situation. So I think the trade down in the price is from speculation and nerves that drove it over 100.
Speaking of headlines, Brian hit on one of the headlines to go carefully through the strait. Also, Reuters out with a headline saying the president is expected to review options to look at oil prices. He's very concerned, according to this report, and people familiar with the impact on consumers and businesses, especially ahead of the midterm elections. So not groundbreaking news there, but again, reports saying the president's going to look into it. At the same time, Joe, you made some moves in the oil market. You're buying a Brazilian oil company and a Canadian oil company. Walk us through those moves.
Just being tactical. So year to date, I've been tactical in trying to build positions in the energy market ahead of all of this. One of the trades that I put on, and it's a trade, it's short term in its nature, so it's running Jimmy somewhere around 90 days, and that's the OIH. I've moved out of the OIH. I think I collected somewhere around 18%. I've taken positions utilizing those funds in Canadian natural resources and in Petrobras. The reason being is sourcing comfortably, securely their oil seems as though that will be something that's in front of us here in the coming weeks. You're seeing both of these stocks do really well since this unfolded. The OIH, the service names, they seem to be struggling right now. So again, it's tactical more than anything else, and that's what I'm attempting to do with energy.
All right. While we're looking at the energy market, we got to talk about the broader impact. Jim, I want to come over to you. Dr. Ed Yardeni raising his recession odds from 20% up to 35%, due in part to the oil shock. When you're looking at the markets, what do you see the broader impact being after today? We are seeing oil prices ease back a bit, but certainly still elevated.
Well, look, I'm no fan of parsing the words the way Brian was. I'm not calling him out. I think number one, you have to be able to speak Farsi to understand what the language content really means, and you have to be inside the inner circle in Tehran, which none of us are. And where I'm going with this is, again, this just depends on how long this lasts. You're seeing in the market right now rational responses in the form of hyper-discretionary stocks selling off, whether that's travel, leisure, entertainment, those sorts of things. Now, they can snap back very quickly if we in some way declare victory and move on over the course of the next week. But if we get to the end of March and we're still bombing Tehran and we're still talking about whether it's Iranian or Chinese or other countries' tankers that are transiting the Persian Gulf, the effects are going to be a little bit more long-lasting. You're going to see it not just in consumer confidence, which I worry about, but you're going to see it in profit margins, which I mentioned earlier. And this can take the form of anything. It can be higher fertilizer costs because natural gas prices are higher, which in turn is going to raise food prices. I mean, the effects of a prolonged inflated energy complex, the longer this goes on, is going to be pretty pronounced. Now, I want to go back to where I was a minute ago. I'm not selling here. I'm not giving up on a diversified portfolio and going to consumer staples or something like that, because I do think, first off, I have a lot of faith, a lot of respect in the U.S. military, and I think there's a reasonable chance that in short order we will get this situation solved, but I don't know, and nor does anybody else. So I am on a razor's edge that I may have to change my stance the longer this goes on.
I think the biggest comfort for the market right now is when you talk about the economy and the cushion it has, is what I said at the top of the show. It's where rates are. The fact that rates have not really spiked aggressively, that's going to be incredibly problematic for the administration, for the Treasury, if we see a significant spike in yields concurrent with what the volatility is presenting in oil. And I think you have to be comforted that we haven't seen that yet.
Well, while you're on that, Joe,
very quickly, does that change the risk that might be for the market coming up with CPI in just 2 days? The fact that we could see a hotter than expected CPI?
Look, my personal opinion is what's going on right now, and even if the price of oil continues to move higher, I don't think that the response from the Federal Reserve to that should be, okay, we're going to raise rates, even if you see an inflationary spike.
Therein lies the problem.
I do not think
it is the Fed.
So there are people that are saying, okay, well, if we get the inflationary spike, you raise rates. I think the actual opposite. I think as oil goes higher, that's telling you probably need some more rate cuts.
Yeah, I would say
rate cuts are backing out. Rate cuts are backing out. We're now down to maybe one, possibly more than that by the end of the year. First rate cut in July. And at the last meeting, they were actually talking about, some people were talking about raising rates. Now, before you get to raising rates, you have to back out the rate cuts. But this should not be off the table for anyone. And I will tell you, we got through 2000. Yeah, exactly. And yeah, Joe.
Really? It's off the table for me.
So you want to raise rates?
Hang on, guys. All three of you, just hang on. Okay,
okay, Jimmy.
Hang on. Just hang on.
Calm down.
Okay. In 2022, you had an oil price spike. That wasn't what cratered the economy or the markets. It was the Fed raising rates. So we should be paying attention to that. We started this year talking about 2 to 3. Now we're down to maybe 1. I mean, you have to back out the rate cuts before you get to rate hikes, and they were talking about it at the last meeting.
Can you call on me?
Yeah, go ahead.
Let me just respond real quick.
Give him a second to get this
in 22, the Fed raises rates, and what happens? We go into an earnings recession. Do you want that again? Do you want them to raise rates?
No, that's why I'm saying be aware of it.
Okay, look. You never say never, but so I'm using that with some poetic license. There's no chance of the Fed raising rates. Not while jobs are going the other way, right? They're not going to do it. Period. End of story. They're not going to cut rates necessarily. Not only that, to them not raising rates. Okay, you can look at the tariff. We're gonna anniversary the new tariffs, the 15%. So that's really a temporary thing that's out of control. Out of control of the Fed in terms of it's not going to be demand driven, right? So they're putting tariffs on it. So I'm not worried about that.
Oil moving higher has a deflationary economic effect on the consumer. Agree?
Yeah, absolutely.
Let me be clear. This is not my base case. I'm simply saying we shouldn't dismiss it.
But, Jim, in all fairness, you weren't unclear. I think we were just all shocked that you thought that we may need to raise rates.
Hey, listen, they talked about it at the last meeting. Like, that's a warning shot. I mean, just pay attention to this is all I'm saying.
Understood. I want to get on the market. Jim, while you're saying that there's potentially a need to raise rates, I want to talk just about the markets in general. Note out from JP Morgan's trade desk saying that they see the potential, at least, there's risk for the S&P to pull back to a correction level about 62.70 from its all-time high. So about 10% from the all-time high, not from where we're at right now, but from the all-time high. Do you see potential in that happening? And could this CPI report, if other people see it the same way you do, is potentially a report that could lead to a rate hike? Does that have the potential to lead to that correction?
Yeah, again, base case is not rate hikes. I'm just saying we've got to be aware of it. And as for a correction of 10%, that usually happens in a given year. You should expect it. I mean, we went into this year talking about midterm election years that the average drawdown is 19%. So 10% would be nothing. And by the way, when drawdowns happen, when corrections happen, there's always a reason. It doesn't just happen just because. There's a real reason, and this is a real reason. Now, I do think that the economy is strong enough to get through this, but as I've been saying, the longer it goes on, the more damage can be done.
I don't know. It feels to me like we've had that correction, but it's not in the overall market itself. It's underneath the surface. It's in the financials. It's in, obviously, a lot of the private equity names. It's in software. It feels to me we've experienced that already. What can probably avoid us having a headline S&P 500 10% correction is the strength that's being exhibited recently in the names like Alphabet, Apple, and NVIDIA.
One thing we have to address is the pullback in the VIX, still elevated at about 27, almost 28, but off of its highs of at least the open, where it was about 32. What do you make of this pullback? Is this simply reflexive when it comes to oil prices pulling back?
I think one of the reasons, Steve doesn't want me to use the word resiliency, but one of the reasons why when the market looks its worst, we recover is because there is a perceived hedge against the volatility, and that's the price of crude oil, and we're seeing far more activity there on the part of speculators. Whether it's retail, I don't know that it is. I think it's more institutional. But you have that hedge against the volatility, and it's the spot price of oil.
Yeah. Weiss, I want to get your take on it. By the way, Wolf out with a note saying they see a notable spike in volatility ahead. They believe it's going to break through 30. Obviously, it already did, but they believe there's more upside when it comes to volatility.
There's more volatility is what they're saying?
Yes.
Yeah, I don't disagree with that. But again, volatility goes both ways. People tend to think of it, there's only downside volatility.
That's why I came to you. So,
right?
So if the volatility goes up, where do you put the money?
Look, as I said, we could see the president come out and declare victory, and I think that would be accurate to a certain extent any moment. It depends how much pain he's willing to tolerate in the polls, which would be painful going into Iran, and how much pressure he's getting from the party in advance of midterm elections and rising oil prices. In that case, I think you'd see a really big uptick in the market, a nice bounce. I don't know how long-lived that would be, but it would definitely bring back, the VIX. So I don't really focus on the VIX. I focus on companies. I don't focus on the technicals, I do look at them, but I take a look at where the corrections really hit the market. Take a look at a Goldman. I mean, Goldman, that's come down. That was on its way to breaking 1,000, and now we're down, and flirting with 800 on the downside. Anything changed for them? Not really.
Okay.
So that's where I am.
You got your NASDAQ higher.
You were looking at the NASDAQ right here, just fractionally higher right now, poking its head into green territory right now. By the way, Emily Wilkins down in Florida right now with GOP leaders in a retreat. So we'll have to see if anything comes out of that. To your point, Weiss and Joe, also about the president maybe changing his mind, maybe getting a push from his own party with the midterms coming up. All right, coming up next on Halftime, our top call of the day. One firm saying for the first time in 5 years, this beaten down sector, it's a buy. We're going to see if the desk agrees. More Halftime coming up for it. It is time for our call of the day. It's on software. Dave Davidson calling this space investable for the first time in 5 years. A lot of ownership here on the desk. Why don't we start with the name that's going to be reporting this week? It's Oracle. Jim and Joe, you both own this one. Joe, I'm going to start with you.
Okay, Jimmy, am I allowed to go?
I love you. Please go ahead.
There you go. Earnings up 16%, revenue up about 14%. I think they really have to define business conditions for Oracle Cloud Infrastructure. They have to talk a lot about the businesses that are unrelated to the partnerships with Stargate and with OpenAI. They have to really detail that they are more than just that ultimate relationship. Now, am I confident and I'm comforted that they can get past all of that? Not necessarily sure. I think, though, when you look at software, Oracle is one of the names along with Palantir and Cadence Design, which we own in the ETF, that bottomed in early February and has been able to kind of, through the month of February, withstand some of the significant volatility that's been present in the market and not kind of break down further. I like Cadence, I like Palantir a little bit more than I like Oracle, but I do think you have that point of reference to look at and say, okay, maybe we've got some stability and the worst is past on some of these software
Joe, you're
names.
on the clock. You're starting to cut into Jimmy's time.
I'm sorry.
So,
I apologize, Jim.
We got to keep it serious, guys. By the way, the names that the D.A. Davidson analysts like, Adobe, Microsoft, Palantir, and Oracle. Everybody owns Microsoft. Weiss, I'm going to come over to you. One of their points in this is they say that investors are basically misunderstanding the impact of AI and that it's put companies like these at an attractive valuation, again, to their point, for the first time in 5 years. Do you agree with that thesis when it comes to Microsoft?
Well, I've been adding to Microsoft. It's now a core position. The truth is you can't misunderstand what you don't know. So all you can do is make a bet. So D.A. Davidson has no idea the impact of AI on any company. But what you do is you assess where they are positioned and what you think they can do. Let's keep in mind that Microsoft was in front of it, as was Google and others, but Microsoft, their investments in OpenAI before anybody's really investing in them. So I'm making the bet that this is going to be good for Microsoft. I've backtracked from my position that they're going to benefit more than anybody else. But I believe they know what they're doing. Some of their core products, right, like their Office suite, definitely take some hits on it. But, I'm there. I think it's cheap, cheaper than it's been in a long time. And I think that this one's been risk managed pretty well.
But you also liked it when it was higher, in all fairness, because you were adding to the position.
I did, but it wasn't a core position, and now it's a core position. So I've been adding to it a lot.
In general, if you look at the IGV, software is about 26% off of its 52-week high. I'm looking at Adobe, about 37% away from its 52-week high. Harder hit than a lot of other names. Jim, coming over to you.
Yeah, it has been hard hit. Sorry, I'm chuckling about it. But reports on Thursday. They've had very good reports for the last several quarters in a row, and it has had absolutely no positive effect on the stock, hence being down 37% from the high. However, now trading at about 12 times earnings, what I'm actually looking for here is how many shares did they buy back? Over the last 5 years, they've shrunk share count by 12%. I believe in the company. I ask rhetorically to everybody on the desk, to everybody watching, how many PDFs have you opened today? Don't answer, but it's a lot. Okay, the PDFs are not going away, but that's only one half of the story. All the bears are saying eventually they will, that AI will not only replace what Adobe does, but will kill all the jobs that are being paid for in Adobe's revenue stream on a per-seat license basis. Ultimately, I see this as a long-term winner, 12 times earnings. Let's look for how many shares they've bought back.
Yeah, I think the question really is about the creative cloud business, not that other part of the business with PDFs. But we'll have to wait and see, Jim. Looking at Adobe shares, down just about 1%. We want to turn to D.C. now. We're getting some news out of Washington. Let's get to our Eamon Javers with the very latest. Eamon.
Frank, that's right. I've just been on the phone with sources familiar with the G7 meeting this morning. That's been really the focus of attention in the oil markets today. And what these two sources tell me is that this meeting tomorrow with the energy ministers is going to be tomorrow in the morning. It's going to be a virtual meeting, not in person. And that is scheduled tomorrow morning, U.S. East Coast time. Sources also say that talks among the G7 are, quote, positive, unquote, in terms of the possibility of coordinated action in releasing reserve oil into the market. Any coordinated action on that would occur, of course, after that energy ministers meeting that's scheduled for tomorrow morning. The source is also confirming the U.S. stance on this, which is the U.S. believes that a joint release of 300 to 400 million barrels, representing 25 to 30% of the 1.2 billion total barrels in reserve, would be the appropriate amount. So the U.S. is asking here, or suggesting here, that a joint release among the G7 nations from their reserves of 300 to 400 million barrels, representing 25 to 30% of total reserves, would be the right move here. So a little bit of guidance heading into that meeting tomorrow. I know a lot of folks were watching that G7 meeting this morning and may be surprised that they didn't move jointly on releasing reserve oil. Well, I think the expectation is that this meeting tomorrow among the energy ministers will be the key decision point for that, and we'll see what happens. Frank?
All right. Eamon Javers live in D.C. with the very latest. Eamon, thank you very much. And welcome back to Halftime. Let's get to more calls of the day. GE Vernova, double upgraded to a buy from a sell at Rothschild. Headline here, Weiss, you own this one. The facts have changed. They also go on to say they expect upgrades to guidance.
Yeah, so look, I'd like to tell you this is a core position, but it's not, because the valuation, I think, is kind of high, at least compared to the rest of my portfolio. Nonetheless, I own it. What's not going to be impacted by the Iranian war or anything else is the build-out of data centers and the need for energy, the need for power, et cetera. So that's going to keep on going, and that's why I own GE Vernova. Others that own it would say it's not overvalued, but I wouldn't say they took this opportunity of a decline in the shares to upgrade it, because it's held up pretty well, much to my surprise, during this whole downdraft.
All right. We're talking about a lot about the impact of rising oil on the economy. Wolf actually out with a note saying they see Costco as one of the winners, with WTI trading close to 100. They say it's 100 plus. They say expect to trade down to consumables and non-discretionary items. Joe, you own this one.
Costco has made a remarkable recovery from where it was in the fall. We're seeing a little bit of a pullback here in names like Walmart and some of the discount retailers. I would include in the conversation Costco, TJX, Five Below, Ross Stores. Those are the names that I think, as consumers continue to be value-oriented, looking for bargains, I think in retail they will be the winners.
All right, Jimmy, I want to come to one of your names. Apple, maintained as a buy at Citi with a $315 price target. They believe that Apple can navigate the memory component price hikes much better than tiers, and they see incremental pressure on gross margins.
I own Apple, so I am bullish on it. However, I do have to point out that I own it at 1/2 the overall market weight, which is my way of saying that I think there will be an opportunity to add that other half back. I recently did that with Microsoft at 386. So I'm not saying that from here to the sky is where Apple's going to go. There might be a pullback just based on valuation. Low 30s based on the growth rate of the net income. I don't think that's the right price. But I'm not giving up on the shares I have. I'm looking to add.
All right, speaking of memory, Joe, I'm going to come back over to you. Micron, big upgrade from also Citi, actually, 385 up to 430. They say the stock has sustained gains this year. However, outperformance could moderating in Q2, I should say.
So I believe they report next Wednesday, the 18th. We want to sit and kind of wait patiently for that report before you take any action. We are long in the ETF, and a lot of our ability to be long is predicated on the remarkable momentum that this stock has experienced. It's up nearly 200% over the last 6 months. And why is that? It's because of the strong pricing environment for dynamic random access memory, DRAM. Now, at some point, the appreciation, the significant appreciation, the expectation is in 26 you could see DRAM pricing up greater than 150%. At some point, that's going to level off. And generally, if you go back into prior cycles, Micron has proven itself that it will peak ahead of that. So at some point in 26, you're probably jumping off of what's really been a strong train. In addition, they have to answer the questions surrounding the relationship that NVIDIA has announced with SK Hynix and Samsung. That could be somewhat problematic as well. So take a wait-and-see approach. Let's hear what that report is and get to the other side to make a decision.
All right, we're going to leave it there. And we are back on halftime with final trades. Jim, you're up first.
So this company, you may have heard of it, NVIDIA, has sold off after great earnings, great guidance. We understand the drivers here. It's a great valuation. Final trade, NVIDIA.
I have heard of that name. Weiss, you're up.
Netflix. I think you get to play offense and defense with Netflix because it's been through the wars already. It's corrected, and I think it's on the upswing right now.
Joe T.
Live Nation reached a settlement with the DOJ. They get past that obstacle. Strong momentum heading into the summer, a lot of activity.
All right, there go your final trades. One quick look at the markets before we let you go right now. As we mentioned, the NASDAQ firmly in the green right now. We're looking at the S&P. It's pulled back a bit from the levels we saw, down about 0.25%. The Dow down over 0.5% as well. That does it for halftime.
Guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with a market on edge. Stocks under pressure, not quite as bad as they were, but nonetheless, red across the board. There's the look. With the last stretch of trading now beginning, weaker than expected employment report. It gave the market a gut punch right from the beginning. Along with that big jump in crude that Kelly and Brian were talking about, stocks started careening pretty early. Look at that. There's crude, up almost 13%. We are above $91 a barrel. We're watching far and wide. The banks as well. They've not traded well. Restaurant names, you might expect gas prices are up, restaurant stocks go down. That's just the way it works, and they are mostly there as well. Same too with the airlines. Fuel prices higher. It's been a bad group all week. American Airlines down 5%. The VIX spiking today, so it's an unsettling picture just about everywhere you look. There's a 12% move in the VIX, but more substantially, it's at 26. Let's begin, as we have been for most of this week, in Washington with our very own Eamon Javers. He has the very latest for us on what the administration is now saying about this war. Eamon?
Scott, that's right. We believe that at this hour, the president and the Secretary of War, Pete Hegseth, are meeting behind closed doors with defense sector executives. That meeting was scheduled to begin at 2:30 at the White House. And we have a list here of the defense companies that were invited, including Lockheed Martin, Northrop Grumman, RTX, Boeing, Honeywell, and L3Harris, all expected to be in the room for this meeting. We don't have an official agenda here, but the White House says this meeting was scheduled weeks ago, so that is before the war in Iran. The president has voiced a number of concerns over the past couple of months about the speed and volume of American defense production. He believes that defense CEOs are paid too much, and they don't produce enough, and they don't produce it fast enough. So that is the expected message to these defense CEOs, Scott, in this meeting today. But if we can get any sense after the meeting breaks up of what has occurred, we will certainly bring it to you. The White House says that the United States certainly has enough munitions now to proceed with the war in Iran. This is not, they say, about any concern about depleted reserves in the short term. Scott.
All right, Eamon, thanks so much. Keep us up to date. Yeah. I know you will. It's Eamon Javers in Washington for us. More now on that move in crude today. Pippa Stevens is following it as she always does. Hi, Pippa.
Hey, Scott. WTI seeing its best week since the contract's inception in 1983, jumping 36% with no indication of when ships will be able to transit the Strait of Hormuz again. Some $17 billion worth of oil, LNG, and petroleum products now stuck in the Arabian Gulf, according to Kepler, with the administration announcing last hour a $20 billion reinsurance program for tankers transiting the Strait. JP Morgan saying the total amount needed is more like $352 billion. Now, TDC's Brent hitting 100 next week if no progress is made, with a potentially violent repricing higher the longer this continues. Heating oil, which is a proxy for diesel, seeing its best week on record, up 36%. That is lifting refining stocks, with Marathon Petroleum and Valero up double digits on the week. The energy sector overall, the top S&P group, up better than 1% for the week. Scott?
Thank you, Pippa Stevens. Stocks are off their worst levels, as I've been telling you. We're still poised for a down day, to say the least. Let's bring in the Professor Jeremy Siegel of the Wharton School, Professor of Finance. It's good to see you, Professor. Welcome.
Welcome, Scott.
All right, so you've had a chance to absorb a week, right? We've had a week.
Yeah.
What do you take from it?
I'm very cautious. I say if we don't get some breakthrough over the weekend, I think we'll see $100 oil next week. And remember, it began the year under 60. I mean, that would be if we do get that, that's a 70% increase in price, and that will set. I mean, I think gasoline is set to soar in any case. So I think there are headwinds. Now, your other guest thought that the tax refund might offset them, but I think that the oil shock actually could be bigger than what we get on the refunds, which were well advertised, and some people have probably already maybe spent their extra money. So I wouldn't be surprised to see a correction in the market. We haven't had one for a long time, and I mean, that would be, we're not even in the pullback zone yet, which is, 5 to 10%. Correction is 10 and more. I don't think any bear market is coming. And by the way, I mean, if we get a breakthrough, we would get a coiled market spring upward. But trends look like this is going to drag on a lot longer than I and the administration had hoped.
Oil matters more than everything else. That's what I hear you saying, correct?
Yeah. In the short run here, oil does matter more than anything else. The price of gasoline is probably the most visible price of any price in the consumer basket. We're in a midterm year. Politicians are going to make an awful lot of it one way or the other. The Democrats themselves didn't like this war. They're going to blame the high price on gasoline on Trump. So there's going to be a lot of fighting back and forth on this issue. And, it's from what I've talked to some oil experts, and the shutdowns, what is going on in the Gulf, what is going around the world in terms of shipping, it's cannot be fixed overnight. It's going to have some lasting effects, at least in the near term, on the economy. In the long term, I'm as bullish as ever, so don't believe that. But I do think that what I see short term does worry me.
But outside of oil, what inside the market is most concerning to you? What group? Is it the banks? Is it the private credit-related names? Which ones?
Well, I'm bullish on everything. I mean, I actually was a little puzzled about the jobless number that we got today, the jobs number. If you take every short-term labor indicator, the jobless claims, the Challenger layoff reports, the ADP weekly reports that we get, all those, and the ISM reports, even unemployment, they didn't show a big decline. I mean, Hassett said maybe we should just take the 3-week average. But I think one thing is really interesting and I think very positive, and that is GDP estimates have not really gone down. Now, I know Atlanta just lowered theirs a little bit this afternoon. Goldman Sachs is still over 3% for the first quarter. Now, think about that. With a job loss and still having over 3% GDP, what does that mean? That means productivity is really exploding. And that's ultimately good for real wages, good for the economy. And we saw the trend in those last 2 quarters that would continue. I think if this war gets resolved, boom, we're going to get on. But if it drags on, the visibility on oil prices is going to be a drag.
But if I asked you, I said, hey, what about the banks traded poorly? What about private credit? Big concerns there. And you said I'm bullish on everything. Neither of those things concern you at all?
Well, the private credit, if you take it the marketable, the spreads on the marketable bonds that are investment grade versus non-investment grade, they have come up a little bit, but not very much. This whole thing about private credit, and they enter an agreement saying you can take 5% off, and then when you want to take more, everyone panics. Well, hey, that's what a long-term illiquid investment is supposed to be. Now, that being said, I do believe that the space got overcrowded, and I'm not would not be surprised to see some investors in that space taking some big losses. But the only way the banks are going to be taking big losses if we have a recession. Could you say these higher oil prices could bring about that? Given that we have virtual energy independence, it's a very different story than the 70s and the 80s. So, yeah, slow down, no recession. That's what the bank loans and the bank portfolios are. I mean, we see really no other slides in the assets, not a crazy mortgage situation like we had before the great financial crisis or anything like that. The balance sheets of banks, I think, look still very, very good.
Banks have come off their worst levels of the day. It's helped the overall market. Professor, always appreciate your insights. I know we'll talk again soon. That's Jeremy Siegel of the Wharton School. Up next, we track the biggest movers into this close, and we do that with Christina Partsinevelos. Hi there.
Hi, we have one financial giant blocking investors from pulling their money and why that's rattling the credit markets. We discuss next.
All right, we're about 10 from the bell. Back to Christina now for the stocks she's watching. Tell us.
Let's start with fertilizer stocks because they are rallying as those companies are likely to benefit from tight supplies and higher prices, of course, due to the war in Iran. More than a third of raw materials actually used in fertilizer travel through the Strait of Hormuz, and that's why you're seeing names like CF Industries hitting a fresh 52-week high on pace for a record close, up 4%, Nutrient up to almost 2.5%. And shares of Samsara soaring today, up almost 20% after issuing strong full-year guidance. This is a software company that connects physical operations like construction and freight and has struggled. Like many other software names this year, it's still down about 17% year-to-date before, or as of yesterday's close, I should say, but you can see really getting a bit up right now. Scott.
All right, Christina, thank you.
Hello, welcome to Blue Cloud Trading. I'm George. It is Monday. It's March 9th. It's 5:30 p.m. and the market has closed. We just saw some clips from CNBC halftime report as well, and the closing bell. Jeremy Siegel, Steve Weiss, and other guests on halftime report. They went over a number of stocks, and we're going to cover a lot of those stocks. In fact, guys, by the way, take a look at the markets, how they closed. Okay. Dow was up 0.5%, NASDAQ up 1.38%, S&P 500 up 0.83%, and the Russell 2000 up 1.09%. So the market started to rally towards basically the last hour from 3 o'clock until 4 p.m. You can see that big move up. We slowly, as you can see here in the morning, we had basically gap down. Then we reached a little bit of a low down here around 10 a.m. and then the market just started to continue to move up since that point. You can see a little consolidation right there, boom, and then at 3 p.m. everything just started taking off, which is very interesting. Let's find out what caused that real quick here. Let's look at some of these headlines. For example, so it says stocks rebound from early losses as oil retreats on G7 reserve signals, with tech and defense leading gains while traders monitor U.S., Israel, Iran tensions and upcoming inflation data. Oil surged above $110 on escalating U.S., Israel, Iran war fears, then retreated below the $100 after the G7 reserve release hints and White House intervention. Defense sector stocks remained strong amid heightened geopolitical risks. Airlines and banks lagged the broader market, performing during the session. And energy stocks swung sharply in line with volatile crude oil prices. Very interesting, very interesting. And yeah, traders remain focused on the U.S., Israel, Iran dynamics, Iran's new supreme leader, Strait of Hormuz risks, and upcoming CPI, PCE inflation data, and central bank rate cut prospects. This is what the heat map looks like for the day here. You can see the technology stocks start to rebound, especially the semiconductors. Look at this. NVIDIA was up 2.73, Micron up 5.14, Broadcom up 4.6, Google was up 2.63, Apple, Amazon, Tesla, they were all up, Microsoft up slightly. The financials, though, struggled. A lot of red right there. The healthcare stocks did pretty well. The majority of them were up. Everything else was mixed. Consumer defensives didn't do so bad. I mean, they were kind of mixed as well. Here are the groups. We can take a quick look and see how the individual sectors perform. You'll see technology, healthcare, basic materials were the top performers. Energy, financial down. That's right. I mean, actually, energy was up just 0.02%. So in this video, what we're going to do is actually take a look at the S&P 500, the Qs, the Dow, the Russell. Look at the VIX up 14.95%. But at one point, it was, from 25.5, it was actually up at around 35. So it dropped quite significantly there. So we'll also take a look at the Mag 7 stocks: Apple, Amazon, Google, Meta, Microsoft, Netflix, Nvidia, and Tesla. And also about, are you ready? 32 stocks and ETFs, a mixture that were discussed on today's episodes of the Halftime Report and Closing Bell. And then we also have one member request here. So let's let's start off with the S&P 500 like I typically like to do, and we are looking at a weekly chart right now. I made this quick little chart, and I posted this in x.com earlier today. My handle there is at Blue Cloud Trader. So check this very important candle, folks. That's called a bullish engulfing pattern. It's when you see a small little red candle like the one that we had on Friday. Okay, that's red spinning top. And I mentioned, guys, I was a lot more bullish on Friday than I was the prior days. I mentioned that, the fact that we were stalling in that 671.20 level, I mean, that's based on this prior low. That was very significant. So there was a little bit of, they basically tried to fool us here, right? But remember, it's most important because price actually gapped down on today, right? Gapped down, but then look what happened. The bulls started pushing it right back into the zone. That's why it's so important to pay attention to the closing prices. Always focus more on closing prices than on just these little piercings. Like right there, for example, that 671.20 level was pierced, meaning that the price dropped below that level, but then it quickly moved back up and closed above. Same thing here with the little spinning top. Same thing here today, right? Closed back into the zone here between 671.20 and 697.84. I think that when you're going to know that this thing is potentially going to drop and we're going to have a correction is when if we get under that 671.20. This is actually quite a bullish predicament that what I'm seeing here. I like what I'm seeing. There's a higher likelihood tomorrow, in fact, that I think we're going to see the SPY and these indices move up. And I think oil is going to drop. That's right, tomorrow. Here's the QQQ ETF. This is the daily chart. Also, another bullish engulfing pattern. If you're not familiar with that, let me just show you guys what that looks like. We've got this candle pattern reference sheet, it's a little cheat sheet, essentially. And if you look over here on the left side, under double candle patterns, okay, it's this pattern, the small little red candle followed by the big, large bullish candle that engulfs it. So that is, in fact, a bullish pattern, especially when you see it after a pullback, right? And that's essentially what we're seeing here. That its price has pulled back down, and then look at it. It also found support right there at the 200-day moving average. So that's really important as well. The Dow Jones, another bullish engulfing pattern, another small little candle followed by a larger one. This one wasn't red, but it doesn't necessarily have to be red. This is still technically a very bullish pattern. And the fact that we closed inside the cloud tells me that there's a higher probability tomorrow that we'll move up slightly. I don't know if we're gonna be able to actually break through these levels of resistance. I'm talking about the moving averages. And if you guys aren't familiar with what we're looking at here, let me just show you very quickly what we're looking at. This is the Ichimoku indicator. A lot of you may not be familiar with it. You're stumbling upon my channel for the first time, and you're probably wondering what all these lines are. So let me just give you guys a quick little summary. It won't take too long here. But basically, what you have is 5 lines that make up this indicator. You have the green line there, which is Tengen-sen. That's the midpoint of the last 9 periods. You've got the Kijun-sen, the red line. That's the midpoint, basically the middle part of each candle of the last 26 periods. So it takes the high, the low of each candle, divides that by 2, and plots it. Okay. Once you have these two moving averages, then to create the cloud, what we need essentially is the midpoint of these two moving averages. So if you go 26 periods into the future, that creates the Senko span A. Okay. And then you've got the Senko span B, this purple line, which is essentially the midpoint of the last 52 periods. So it's much slower moving average and more long-term type moving average. But instead of plotting it, below or above these moving averages, it's plotted 26 periods into the future, Senko span B. And so that's what creates the cloud itself. Okay. And what we're looking for is single span A to be above the single span, be like a nice bullish cloud. Over here, you'll see that we had some bearishness right there, and we would have seen that. And that led, of course, that's when we had this decline back in early 2025. So what we're looking for now, also, one final thing is the Chiku span. That white line is the current price. It's the closing price right here. But instead of it basically going to the future, this one goes into the past, right? So it's in a line form. So there's the closing price in a line form. And what we're looking to see is where's that in relation to the candle 26 periods ago? If that white line is above, that's very bullish. It's telling us like, hey, price is still in a nice strong uptrend. And we have all of these collectively in the right order. That's perfect. That's exactly what you want. But the one thing that's lacking in this particular chart here is the price. Price needs to also be above the moving averages. Okay, these Tenkan-sen and Kijun-sen, and it's not currently. But this pattern that I'm seeing here is very bullish on the weekly chart. It's called a piercing line pattern. And so piercing line is if you go again under double candle patterns, and let me just show you guys where it is. It's right here. This piercing, that's the middle pattern here. So when you have a red candle and then price gaps down, starts moving up. Now, this is a weekly, all right, which means that this candle is still forming. But right now, it's starting to look pretty bullish. The fact that it gapped down, it started moving up, that's a very bullish sign. Here's a daily chart again on the Dow, re-entering the cloud. So I like what I'm seeing. I'm still very skeptical about this because, of course, the directional movement index is still very negative. That's when you have the red line above the green line. That's the negative DI9 above the positive DI9, and you have the ADX moving up, which represents momentum. The momentum has been, obviously to the downside, but today we may see a potential reversal tomorrow. All right, and let's look at the Russell 2000, same exact pattern, bullish engulfing pattern. Again, everything down here is still, the momentum has been so negative for so long that it's going to take a little bit more than what we're seeing right here. This pattern needs to actually be fulfilled by price getting above the high of that level and hopefully breaking above these moving averages tomorrow. If it's unsuccessful in doing that and it continues to drop, all right, we're most likely to come all the way down to the 200. How far are we from the 200-day? We're about almost 6% away. All right. And another thing that to also keep in mind is if you look, I'm just going to throw on some support levels here. There's also a level of resistance right here, the 258.20. And if I throw one more based on these lows right here, you can see that low right there. Notice how we came down to that level and then price did not want to close under that 246.01. All right. It got back above. So that's very bullish. All right. VIX. Okay, so it spiked, like I said earlier. It reached this high level of 35 and then it started dropping. So VIX represents volatility, it represents fear. So there was a heightened level of fear because it gapped up to this level and then dropped. We want the VIX to be dropping. We don't want it to be moving up. And this is called a dark cloud cover pattern, which is bearish. So these two candles. So you have a bullish candle like this one, and then this one here where price gaps up and then starts dropping and then closes within the candle, the prior candle. I'll show you guys that pattern right here in the candle pattern reference sheet. Like I said, it's a bearish one, and it's called dark cloud cover. It's right here. So again, bullish candle, price gaps up, starts to drop, and closes within the candle. So this is bearish, and that's good in relation to the VIX. We always want to see this dropping. All right, so by the end of the day, you can see the VIX drop 14.95%. Below Friday's. This was Friday was at 29.56, so that's really good. And then we have the FEZ. This is the Eurostoxx 50, another bullish engulfing pattern. You can see here on Friday we stayed above that 200. That's the dotted yellow line. That's the 200-day simple moving average. We stayed above that on Friday. We're staying above it still today. Will we be able to re-enter the cloud? That's to be determined, of course, based on it's all news based. The chart just helps to guide us. Again, it's telling us what's actually transpiring, between the buyers and the sellers to give you a better picture so you can make a more educated guess about whether or not you should buy the stock or ETF or not. It's all it is. It's not predicting the future. It's just giving us it's almost like it's just giving us more insight. And it's not only giving us insights, it's showing us the volume here. Down here, you can see how much the volume has been increasing. You can see, for example, with these patterns, what's happening. The buyers are in control right now as they moved up, and it's up 1.09%. But, you know, this chart has been damaged since we broke under the cloud. So we have to see if this can recover here. Now, check out all the Max 7s here, except for Netflix, which was down 0.71. Everything else was up today. Apple was up. There's a bullish engulfing pattern, but it's inside the cloud. So we don't have a buy signal here, but this is bullish today. I wouldn't be shorting tomorrow, for example, unless price got into the lows here, for example. Amazon is under the cloud still, but today we have a bullish hammer. All right, that's a single candle pattern. That's not a bullish engulfing. That's called a hammer. After price has been pulling back, if you have a long wick and a small body, all right, it looks like, right, see this pattern over here on the left? Drop, long wick, small little body. That leads typically to a move up, but there's no guarantees, of course. Then you have Google, which was another bullish engulfing, but look where it stalled, right at the cloud. There's still a lot to be proved here. Meta also moved up 0.39%, but also stalled at the Tenkan-sen, the 9 period. It's a level of resistance now, right? Microsoft was up just 0.11%. It stalled right at the Kijun-sen. All right, so it's been holding up above this Tenkan-sen now for 1, 2, 3, 4, 5, 6 days. Netflix dropped 0.71, but Netflix has been showing more and more strength recently. But I find it just so interesting, and maybe you do too, the fact that we've been stalling right at the top of this cloud here. It's been finding resistance, right? Essentially hugging it. And so when it finally does break, that's going to be a very bullish signal. I mean, look at the cloud itself. It's starting to become bullish. The single span A, the light colored blue line, has crossed above the single span B. Notice how over here it was under, right? The single span B. Look how bearish Netflix was. Once, everything has to happen in a certain order, right? For example, price has to break above these moving averages. Okay, that's stage one. Stage two, we need the positive crossover. That's when the actual Tenkan-sen crosses above the slower. So the green line crosses back above the red line. Over here, you can see it was under, right? So that was bearish back then. So that's good. We have to enter the cloud. That's very important. It gapped up into the cloud. And then we also have to break through the upper level of the cloud, which we have not successfully done yet, and close above it, not just pierce it, like I said earlier, right? It's been piercing it. It's been retesting the boundaries. And so if it can break through, that's going to be really important. So I like if Netflix can break through that, that's going to be very important. Here's a weekly chart for Netflix, though. This is, if you don't have both of the time frames, the weekly and the daily, confirming that okay, everything that looks bullish on both charts with the Ichimoku, typically that's not a stock that I personally would add a position in. I'm very particular about what I'm adding into the portfolio that I share with legend level members and Blue Cloud Trader level members. Each weekend, I share a video like the one I did this weekend. If you guys are curious about it and want to learn a little bit more, here's the one that I just did. Like I said, this is an old one. Sorry, my bad. Hold on, let me refresh this, guys. Let me refresh it. There we go. 2 days ago. I forgot to refresh this. So this one I posted 2 days ago. I go over my entire portfolio, and I also share 30 new stock ideas. In order to get access to this, you need to click the join button and then select either Blue Cloud Trader, okay, or Blue Cloud Legend level member. That's it. And if you want to support the channel, become a Blue Cloud supporter, and I really thank you for doing that. If you want to get just be a subscriber, it's free to subscribe to this channel and hit the notification bell. And there's more links if you click right here, 10 more links. You can find all the links here, including my Twitter page and a bunch of other things, okay, like the $25 coupon for the TC2000 software. And also use this link if you're interested in the FinViz Elite, right? FinViz Elite is this platform right here, which is fantastic. Okay, let's get back. Let's get back to the charts. So Netflix, yeah, it's starting to look more and more bullish, but the fact that it's stalling, and on the weekly chart, it's got a lot of resistance still. Nvidia stalling right at the bottom of the cloud, still inside this box on the daily chart. Okay, up 2.72% though, and look where it's found support right at the 200 today. Came down to it. It actually literally gapped down, got slightly under it, and then started getting bought up. You can see all that in a 5-minute chart here. See, so here we are on the 9th, March 9th, and it just so reached this level. You get a couple of long wicks, and then it started taking off. Retested the 5-minute 200-day right here, dropped, came back, retested that 200-day again, and then, like I said, at around 3:20 p.m., that's when it broke above the 200 and then started moving up like about 1.26% from in the last hour. Here's Tesla, did something very similar on the 5-minute. Here's the daily chart for Tesla. It's still under the cloud though. So one of the rules of this indicator is you don't want to be adding positions when price is under the cloud in my opinion, in either one of these two time frames. So, all right, now there's about 32 stocks, a combination of stocks and ETFs in here. These were the ones that were talked about. Not all of them. Some of them are actually in my portfolio. Those I only cover with members. So let's I highlighted. I already did the review. I already previewed all these. I did the analysis on these, so we can quickly go through them very quickly. I highlighted the strongest ones with a little blue flag up on the top. The rest of these, from Adobe down, not so great. There's something off technically, and I wouldn't recommend it based on the technicals. All right. So let's start off with Costco. Here's Costco. Here it is in the daily chart. You can see the cloud is bullish. Prices above the moving averages. It was up 0.72% today. Here's the weekly chart. It's above the cloud. Tenkan-sen is above Kijun-sen. Chikou-span is above price. We broke through that trend line. It's been moving up. Overall, I like Costco. The cloud itself looks like it's just about to turn bullish. Senko-span A is going to cross above Senko-span B. So that's looking pretty bullish to me. IPI is another one I like. Basic materials, they talked about agricultural inputs. Even though it dropped 0.96%, as you can see here on the weekly chart, we were this is a stock that at one point, folks, was around $763 per share. Since that time frame, back in 2008, wow, that goes back to 2008. Think about that. Never really recovered. Think of how many years have gone by, and here we are in 2026. Since that point, it actually dropped approximately 94.5%, but it's now starting to. Intrepid Potash Inc. is starting to show signs of strength. Since these lows down here in 2024, it's moved up 134.58%. So it reached, lows. Oh, actually, there were even lower lows. Sorry, I take that back. There were some lows going back to 2020. It looks like right around $7 a share. So since that point in 2020, it's moved up 498%. Wow, amazing. So yeah, around 400, a little over 400 something percent. Bottom line is currently on the weekly chart, it looks bullish, but not liking this candle that's forming. Here's a daily chart. As you get this bearish cloud, I'm sorry, dark cloud cover, right? It's when price gaps up and then drops and closes within the body. So I wouldn't be adding positions here, but technically speaking, when you look at where price is in relation to the moving averages, it's above, and the cloud's bullish, and the directional movement index looks great here, and the Chikou span is above price. All these things are in order, but I just wouldn't be adding a position here because of the weakness that we had today. LYV, Live Nation. I talked about this inverse head and shoulders pattern. Look, if I highlight this, it shows the date that I created that little comment. It was created back on December 25th. December 25th, okay, 2025. And here we were back here in December. I said, oh, that's interesting that, so probably like, I think it was around this date right here where I said, guys, look, it looks to me like we're basically breaking through this inverse head and shoulders pattern. And so there's the head, okay? There's shoulder one, shoulder two. There's the neckline, that long yellow line that you see there. There's the breakout right there. It did pull back, found support at the bottom of the cloud here, and then broke back above the 200 and continued. So, like from the low of the head here, it's moved up 32.39%, and it's still looking extremely bullish. So, Live Nation daily chart, and here's the weekly chart. I'm sure Josh Brown is very happy about this. You know that he likes this stock quite a bit. NOC, Northrop uh, Grumman Corporation, Aerospace and Defense. This industry has been doing quite well. Obviously, here's the weekly chart. It's everything looks bullish, pretty much, except for this reversal type candle that's forming. Here's a daily chart. Would I be adding here based on today's action? No, another dark cloud cover. So I'd wait for more bullishness first. Oil K, a bearish engulfing. So this is where it gets interesting. Earlier in the show, in the beginning, I mentioned that to me, oil is starting to look a little bit scary, a little bit of a scary type of hold at this point. So I'm very particular now. I'm only holding the strongest stocks that are looking the most bullish. I closed out of a number of oil stocks earlier today, and I shared that with Legend level members. So Legend level members get access to the trades that I place, and I shared that before the market closes. I think it was around 1:30 p.m. or so today. Um, but basically, yeah, this is not, this is starting to look a little bit scary, honestly, because you've got this small little candle here from Friday, and here we are today on Monday. Price had gapped up and dropped. And guys, let me just show you the bearish engulfing pattern. We've got this over here on this side. It's the complete opposite. There it is, bearish engulfing, small candle followed by a large red candle that engulfs the prior one. Okay, so it doesn't really matter how small or big this is. It just has to engulf the prior candle. That's what's happening here. Now, the fact is that we did come down to the 4740 level, this weekly level, which goes back to this date here, right here on this candle from January 16th of 2025. Okay, 4740. And it did stall. And it looks like it got bought up a little bit. Here's a 5-minute chart that shows what happened when it reached that 4740. Look at that, a spinning top on my level, which I created back on March 5th. Okay, today's March 9th. So the fact that this happened is kind of interesting to me. Yeah, so tomorrow's going to be an interesting day. And look at the volume, by the way. Do you see this? It's about, I don't know, was that 3, 4 times the volume of like Friday? So today was a very active day. All right, let's go to the next one. ROST, Raw Stores. I like this one. And the reason it's in here and it's got the blue highlight because price is technically still above the moving averages on both the daily and on the weekly. Very important that both time frames give us the same information, right? And we're above the 200-day, but I just don't like what's forming here today. ROST, Ross Stores. This one had a little pullback, as you can see here, but it's up 0.19% today. Here's the weekly chart, very bullish still. RTX looks good, very bullish chart on the weekly and on the daily chart. It is still holding up above the moving averages, even though it was up down 0.72%. VLO, Valero Energy Corporation. This one pulled back today, down 3.86%, but it did find support right at the Tenkinson. So this is what leads me to be very skeptical. I'm not 100% sure where this is going, and I think the market is unsure as well, and that's why we are stalling at these support levels until we get more information. Obviously, what about XLE? XLE doing the same thing. That's the energy sector, right? ETF stalling right there at the 9 period, just waiting it out. All right, now the rest of these stocks is something technically wrong with the Ichimoku in relation to the Ichimoku indicator. So we don't really need to spend too much time. I'm just going to tell you what's wrong with it, and then we'll move on to the next one because there's too many stocks here. We can't sit here and overanalyze everything. If price is into the cloud, it's bearish. It's something I would skip basically. And here, Adobe's exactly in that situation. It's also in a downward channel. APO under the cloud, I'd skip this one. The Boeing is actually inside the cloud. Okay, another rule of Ichimoku is you don't want to be adding positions when price is inside the cloud either. So on the daily chart, it's inside the cloud. I'd skip that one, obviously. BAC, Bank of America, is under the cloud, down 1.56%. No on that one. Citigroup is also under the cloud right now. Okay, coming close to the 200. Maybe it will bounce, maybe it won't. CDNS, also under the cloud. That's Cadence Design Systems. I'd stay out of that one. CG, Carlyle Group, same thing here. D-Dog, under the cloud, under the 200. No, thank you. Goldman Sachs, same thing, but it's found some support at the 200. So I wouldn't be shorting these because, as you can see, if you see any stocks that were up today, I certainly would not be, shorting them if they're finding support at specific levels. But I also wouldn't be buying them. I think they just need to prove themselves. HON, this one here, for example, has a nice bullish pattern. The hammer, almost a hammer type candle, but it's still under the Tengensen, so I'd skip this one too. But it's overall the Honeywell on the weekly chart's very bullish. On the daily chart, it just needs to get back above the green line here to confirm that this is maybe going to be a continued move to the upside, so it can create a new leg up. Okay. IoT is inside the cloud and under this 200, so I'd skip this one. Now, the positive thing I'd say about this one is the fact that we do have this little, almost like you can see that higher low right there from the prior one, and we also broke this level here, so we get a higher high on the daily chart. But it's inside the cloud, and if you look at the weekly chart, very bearish. Look where it's stalling, right? The Kijunsen. This is why it's important to look at both time frames. All right, JP Morgan under the cloud, skip that one. Even though, but I wouldn't I wouldn't short it. Look at these bullish candles for me. KKR, same situation. That's the ETF. No, it's not. KKR and Company Limited, financial services sector. Morgan Stanley, same situation, finding support at the 200, but under the cloud. OIH, pulled back. I like what I'm seeing here. This has a higher probability than the rest of those stocks that I just mentioned of actually bouncing. Okay, it's stalled right at the 364.08. That's a monthly level, that purple line. I'll switch it over to monthly so you can see. It's based on this little candle from September 29th of 2023. Yeah, I'm going that far back to see where we can find resistance levels and where we need to clear, basically, to move up. Here's the weekly chart. You can see it moved up. We had a bearish engulfing and it stalled right there, creating on the weekly chart, almost like a bullish harami pattern that hasn't formed yet, technically, fully, because this is a weekly chart. This candle is in the process of forming. And on the daily chart, we have this little hammer type candle up 1.55%. So tomorrow we'll see what happens. This could certainly break down if the rest of the stock market moves up. Oracle, still stuck in between these two moving averages under the cloud. No on that one. Owl, same thing. It's under the moving averages under the cloud. Palantir is under the cloud, under the 200. No. Shopify, same thing. Snowflake, yes, same thing. SNOW, no on that one. TJX, this one looks like it's about to break back above. So this is more bullish. This is something that you do want to put on your watch list and keep an eye on. The cloud is bullish. Chico Span is above price. Tengensen, the green line is above the red line. Price just needs to break back above that green line. Here's the weekly chart. Very bullish. So I like TJX overall. It just doesn't get the blue flag today. WFC, no on this one. It's under the moving averages. And if you look at the daily chart, it is under the cloud. XLF is also under the cloud. It's the financials ETF. All right, so we went through all that. You can see the advantage of using this indicator once you understand it and how quickly and easily you can just kind of skim through and just find the strongest stocks. And Ichimoku in Japanese, it stands for at a glance. And if you want to know about the history of this indicator, Google it. It's very interesting because it was incepted originally in the late 1930s. And the person that put this thing together, Goichi Hosada, probably not pronouncing it right, but that individual held on to this indicator for a long time until the late 1960s when he finally published it. And then the world got access to it. Mostly Japan, they started using it quite a bit. And then we started to use it I think it was in the 80s that it kind of flowed up to where we started using it as well. So a lot of financial institutions use this indicator. Ichimoku, very interesting. All right. And then finally, guys, let's take a look at Target. So this one here, TGT is the ticker symbol. I like what I'm seeing on the daily chart. Obviously, it's a very bullish pattern that we have here. We have a bullish cloud. We've got the single span A above single span B. We've got the Tengensen above the Kijunsen, right? The green line above the red line. We have the Chiku span above price. We pulled back, but then created a hammer. The directional movement index is correct in the correct order. Green line is above the red line, but they're not moving up. The green line should be moving up. It's moving down. That's why price is going sideways right now. And so is the Chiku span. You can see that. So why does it, what would I be concerned about here? Well, the weekly chart hasn't proven itself yet, has not proven itself. It needs to break through the cloud here. There are some bullish things that are starting to come to fruition, though. We get the Senko span A crossing above the Senko span B. We've also broken above this prior high. Okay, so we have a higher high. We also created a little double bottom pattern down here. Okay, so that's a bullish pattern once we break above this high, and that's what we've got going on. But we're stalling at the cloud. We've got this declining 200-day moving average that you have to, watch like a hawk, because once it reaches this level or this level here, once again, it might retreat. It's all really up to, but discount stores should do well in this environment. We'll see if TGT, we saw Walmart looking pretty good, right? WMT, just look at that real quick. Look at Walmart looking pretty strong. But yeah, anyway, that's going to do it for this video. Thanks for watching. Thanks for supporting the channel. Remember to go to my channel here, Blue Cloud Trading on YouTube. Hit the like, subscribe button, the little notification bell, so that you make sure that you get these videos when they come out. And also, if you want to get access to the member only video, and by the way, it's not just one video that you would have access to once you join. You would actually be able to go back and watch all the old ones too. And I think there's a little bit of education in every single one of these videos. So it's very useful. And why not try it out? Try it out for a month. See if you like it. All right, guys. Thanks. I will catch you all in the next video.